You don't go broke from making too little money. You go broke from running out of cash. It doesn't matter how many sales you make. If the timing of your income and expenses don't match up and you run out of cash and you don't have any leverage, you're cooked. How do we fix that? It's by recognizing that revenue is actually a vanity metric. You might look at it like, oh, look how much money I've earned. But in actual fact, you need to be able to interpret your cash flow statements, your income statement, to really know how much money is coming in, when it's coming in, and if you're going to be able to pay your expenses as and when they fall due. So revenue is good, profit is better, but even profit won't protect you if the money is not in your account as and when you need it. That is why cash flow is king, because even if you don't have the money, but you have the leverage, that cash flow will still get you over the line if you're growing. Cash flow is the timing and movement of money in and out of your business. You could be profitable on paper, but in reality, you could be broke. On the contrary, you've got businesses like Uber, who declared a few years ago that they've never made a profit and they are operating in debt because they've got that cash flow to always get them over the line when they need to. You need to adopt what I call cash flow first thinking. You need to forecast, not guess. Every week or every month, think which invoices are due and when are they due? Which bills, subscriptions, and wages are due? How much are they and when do they have to be paid? Using a basic Google sheet or an Excel spreadsheet with Xero to look at your income statement in real time will really help you get that clarity that you need to manage your cash flow effectively. Always separate business and personal accounts. It makes it a whole lot easier. Have a business credit card or use a tool like Xero to have an active bank feed so that every time a transaction happens in your business account, it feeds directly into Xero without that manual input every time. You can also buffer for safety by having 1 to 2 months of revenue in an account just in case you have expenses that you haven't accounted for or that need to be paid, or an unexpected tax bill comes up if you weren't on top of your tax. And finally, you could slow down expenses and speed up income. So try to get payment terms with any suppliers that you can possibly get, and encourage clients to pay sooner by offering a small discount. So which cash flow statistics actually matter? Let me show you some numbers that will actually change the way you think. A US bank study revealed that 82% of small businesses fail due to cash flow problems. A report by Xero and Alpha Beta revealed that late payments cost this is just Australian, small and medium-sized enterprises over $7 billion per year. And businesses with strong cash flow habits are 2.5 times more likely to survive the first 5 years in business. So the lesson here is, if you don't manage your cash flow, you don't really manage your business. Or if you think you manage your business, you're only doing it for a finite amount of time.